Hello, my name is Carlos Irvan, and this video is to explain the basics of blockchain and Bitcoin. So before I do that, let me tell you a little anecdote. About 4 years ago, I went to the Emerge conference here in Miami Beach, and the big topic was blockchain and Bitcoin. And I attended several of the sessions, and I really was confused. I couldn't understand how it worked, what it was, and I think it had to do with the fact that some of them were very advanced for me, who I didn't even know the most basic things, and I was lost. And it was a little frustrating. I would talk sometimes to people from the audience, and the way they would explain it didn't make sense to me. I don't know if it was because they really understood how it worked, or maybe it was myself that I didn't have enough of an understanding of what they were saying. So because of this frustration, I kind of made it a point to try to find out and learn as much as possible. And particularly during the pandemic, like most people, the value started going up like crazy. Then I decided to learn more and more. And basically, this is the result of a lot of research that I have done. But most importantly, my main goal is to really explain the basics, what it is, how it works. So this is really for people who want to really understand the basics, and not it's not advanced, it's not technical, it's not for programmers. My area of research is mostly on the application and not so much on how to develop it. So let's talk a little bit about the history of Bitcoin. So Satoshi Nakamoto, okay, who a lot of people don't know who this person is. There was a recent lawsuit. Craig Wright claims to be Satoshi Nakamoto, but then there is a lot of people say that he's not, and so on. Bottom line is, he or she or they invented Bitcoin, and basically he sent out a message to a group of cypherpunks. They were like cryptographers and libertarians. Libertarians are people who basically don't believe in central government. They want, basically to have as little or no government intervention as possible. So they have been working for a while on some sort of digital payment. The issue was that there was always you needed some sort of centralized person or entity or something that would verify these transactions, because otherwise you would have what is called the double spending error, or sorry, the double spending issue. So that means that if I send a digital payment, right, who monitors that I don't send the same digital payment to somebody else? In the case of a bank or credit card, or PayPal, they do that verification. They verify that you do have the money, and second, they, through a ledger system, they make the deduction once you send it. So basically, this quote right here, he's been working on the electronic cash system. So up to here, fine. That is fully peer-to-peer. So again, remember, peer-to-peer started. You may remember Napster, BitTorrent. So basically, you had already decentralized ways to share information, files, movies, music, but without a third. You really didn't need a third party because there was no need to verify or duplicity and all that stuff. So in that case, it worked fine, but in the case of money, it's different. So the big thing that his big contribution is, he said, look, we can do this with no trusted third party. And the big deal is that you can do digital payments without a centralized or without a central entity or a third party entity like a bank or a government or a company. So this is the big deal, and we'll see how that's done. Another piece of history which is important is that, in order for people to adopt Bitcoin as a digital currency, somebody needed to buy something with it and try to figure out what the value is. So it wasn't until 2010 that this Laszlo Haniek Basically, he posted that he wanted two Papa John pizzas, and he was willing to pay. He started probably at a much lower number, and until somebody said, "Yeah, okay, for 10,000 Bitcoin, I'll buy the two pizzas for you." So this was really the first transaction, and it was the way to, if you will, to measure the value of Bitcoin because you everybody knows the value of the two pizzas. I don't know, maybe it was like $15 or $20. So $20 or $15, 10,000 Bitcoin. So if you do the math today at 60,000 or 50,000, you're talking about like $600 million for two pizzas. So you can see the appreciation. These are the two most expensive pizzas in history of humankind. So anyway, May 22nd is Bitcoin Pizza Day because it's the kind of the anniversary when the first transaction or purchase was made um, with Bitcoin. So what is when you think about Bitcoin? How can you think if Bitcoin really is like money? So the common definitions and functions of money is when you think of money, it functions as a medium of exchange, right? So basically, you pay $10 and you get, I don't know, a Big Mac combo with dessert. So there is a medium of exchange. That's the main purpose of money, right? In the past, they used to be, I don't know, they would give fish, and in return I would give you fur or something like that. And so there was always this medium of exchange. And when you had gold coins, again, you needed to buy something, you had gold coins. So a medium of exchange. So this is very important, and that's why this pizza transaction was so important because for the first time it was used as a medium of exchange. Okay. Also, it establishes a unit value. So now we know, well, those two pizzas are 10,000 Bitcoin, right? And a store value. So hopefully the currency appreciates over time, so you can save on this currency, and it will appreciate in value. So this is commonly known as the three functions of money. By the way, Bitcoin is, if you think about it, is not that good in any of them, right? And why is that? Well, you cannot buy everything with Bitcoin. So as a medium of exchange is so-so. Unit of value, okay, we know that you can see what the market value is, but there is a lot of debate if that's a real value or not. And the other thing is that it's very volatile. So, and we'll see that in a second. The same thing with store value. It has appreciated incredibly over time, but then again, it's very volatile. So if you buy when it's in the high and then all of a sudden it stays low for a couple of years, as we saw we'll see in a moment, then all of a sudden you can lose a lot of money. So it all depends when you buy. Over time, most believe that it will continue to appreciate. So what are some of the characteristics? And this is important because for a currency, or what is called a fiat currency, for example, that's like the dollar or the euro, to be considered strong, it needs to be stable. There needs to be scarcity, so it cannot be unlimited because then it loses value. Accepted, so there's a lot of currencies out there that are not accepted because they have no value. Divisible, because obviously if you're paying with cash, there's fractions and so on. Portable, so this is very important. So one of the issues with gold, prior to the existence of bills, was that imagine carrying a bag of gold to pay for a house or whatever. So it needs to be portable and durable. And durable really refers to, that you don't have, like it happens sometimes in some countries in Latin America that every 5 years you change the currency. So it doesn't have to do too much with the paper because, for example, the cash is you print cash, and I'm not talking about the money supply. You print bills every so often. It's the Department of Treasury, and it's backed up by the Fed and so on. So it has to do more with the value and not so much with the materials. So why is there so much interest in Bitcoin? Well, it's kind of obvious. So this is kind of what I was talking about. If we look on Thanksgiving Day, so this is a tweet on Thanksgiving Day, 2013, $832. 2021, $58,000. By the way, now I'm recording this video, it's about 50. Now, if you notice what happens and why is it that the adoption of Bitcoin has taken a long time is because it went down, stayed down, it went up again, but it's still not as high as before. So 2016 was still lower than 2013. Then it made a huge jump, okay? Actually, this was around the time that I went to that conference, and I remember then all of a sudden it went down by half, and then it went up a little bit, but still below. So again, this is right here not very attractive for a lot of people. But all of a sudden during the pandemic it took off, and then in 2021, my God, well, obviously everybody. So unless you're under a rock, you know that Bitcoin has appreciated and a lot of people have made a lot of money. So this is the reason why there is so much interest in, or a lot of people want to make money. Okay, now as we talked, there is a lot of volatility. Only looking at, this is from June until now, and look how much volatility, right? So all of a sudden you have here like 34,000 around the 30s, then it goes over 60, then it goes back down again. So extreme volatility. So this is one of the issues, because what happens is a lot of people get excited when it starts going up, and they buy, let's say they buy around here, and then all of a sudden for a month or so it goes down. So this is one of the issues with Bitcoin, right? That there is a lot of volatility. So let's talk a little bit about blockchain. This is a slide that I'm borrowing from a Professor Gensler, who is the SEC chairman now, but he teaches a course or taught a course on blockchain money. By the way, you can find this course in the MIT Open Courseware, and I highly recommend it. So this slide is very much used to explain blockchain. So let's look at some of the characteristics. First of all, the word says a lot, right? Blockchain. So it's a chain of blocks. Now, what are these blocks? Well, first of all, it's a decentralized database. So let's think about it as a database, but it's decentralized. Now, what is it about this database that is unique? Well, in addition to being decentralized, the way it works is you have blocks, and these blocks have information. And we'll look at a demonstration in a moment. They're timestamped, okay? You can append only, so it means you can only add blocks. You cannot take them out or change the previous ones. You have to make the modification. That's why it's like a ledger, right? So in accounting, if we learn about ledgers, let's say you're using even your checkbook. Well, some people may not remember how to use a checkbook, but anyway, every time you make a change, you need to make an additional change or an adjustment, and you can track back to what was done in the past. The other thing, so the second characteristic is that it's auditable. So that means that it's open to everybody. We'll see an example in a moment where you can actually see in the blockchain not only your transaction, but everybody's transaction. However, it is secure with cryptography, okay? So you don't know who the transaction belongs to, because basically what you see there are hash functions, or the hash, which is basically generated to create a block. And this has to do with the cryptography. I'm not going to get into a lot of details on how these are created. We'll talk a little bit about it in the demo. But this hash function, so this is the cryptography, is for tamper resistance and integrity, okay? Something also that is very important and extremely important to understand the advantages of the blockchain is that there is a digital signature for consent, okay? So again, you have a public key, which is like your account number. So if I need somebody to transfer money to me, I need to give them the account number. That's my public key. And you'll see that it looks like an account number, mostly numbers and letters, but again, it's public. That's the way people can send money to you. Then you have the private key, which is also called like the seed phrase that has all these words. That's the one that you that only you can have, and you cannot lose it, because if you lose it and you for again, you you can lose your money, because the money is on the blockchain, but the way to have access to it is with you need to have your private key. And then last but not least is the digital signature. And this is the part that I think is tricky for some people to understand. The digital so when you so let's say I'm sending Bitcoin to somebody. Again, I'm not gonna make it complicated. I'm just sending, X number point X number of or X number of dollars in Bitcoin to somebody else, and basically both of us have a wallet, and I'll explain a little bit what a wallet is later. So this person has an account number, I have an account number. So basically, okay, I'm sending to you this money, right? Whatever, $10, $100. And basically, when I'm about to do that, I have to sign a digital signature. And the digital signature basically is what verifies that my private key matches the public key. So that's what tells the whole network that there is a match, that this is really coming from the right person. So they're like in pairs, right? So if you think about it, if you don't need to know what the private key is, nobody needs to know what the private key, because I already know with the digital signature that it's been verified. So this is very, very important, because this is extremely important on how the rest of the uses of a blockchain work. Okay, and then you have consensus for agreement, based on what we'll see in a moment. So this is the second characteristic. With the digital signature, you have consensus and agreement, because the digital signature matches the private key. The public key and the private key matches, because the digital signature verifies that it matches. And then you have the third and probably most important piece. This is really the part that allows it to be decentralized, which is, instead of having a central authority or party that verifies, basically you have a network. A network, they're called nodes, or the miners. Basically, they have these nodes, which are basically like hazy computers, and they have to reach a consensus protocol. In the case of Bitcoin, most use proof of work, and basically it addresses what is the trust issue, the trust that this is coming from the right person, and that they have the money, and that everything matches. And this is really what the miners really do. So the miners, and we'll see a demonstration in a second, they're adding blocks with these hashes, and they're also verifying. They're verifying the blocks, and there needs to be the majority, or a consensus, the majority. So it's kind of, they call it like the Byzantine generals problem. So this is basically you have like three troops with the generals, and the only way to win the war if they all agree. If they don't agree, then you lose the war. So here they all have to agree in order to add the block and to be verified. So you have two types of blockchain, permission and permissionless. So you could have in the blockchain some sort of authority or permission granted by somebody. Okay, this is most common in the corporate uses, or a lot of what is being used by a lot of companies with a blockchain. Or now the permissionless, which basically has no authority or no centralization of any type, is really what Bitcoin is, and what a lot of people consider to be the true way that the blockchain should work. Although again, we'll have a whole discussion about one and the other, and you'll see how it makes sense sometimes to be permission. Okay, so the other thing that a lot of people ask themselves is, why are there so many cryptocurrencies? Why are there so many? Well, the reason why there are so many is because each time you have a project, it's called a project, on the blockchain, you can issue what is called a token, or they have many words: a token, a cryptocurrency, a coin. So all of these words are basically mean the same thing. So Bitcoin, just talked a lot about what Bitcoin is, and we'll see more about it in a second. But then you have Ethereum. So Vitalik Buterin, the main founder, basically he said, wait a minute, Bitcoin is a great use of the blockchain, but with the blockchain you can do a lot of other things, and one of the biggest uses is smart contracts. So he came up with this platform that is programmable. Think of it like in your iOS, in your phone or your iPhone, and then you can build all these apps on top of it, or dApps, decentralized applications. So this is very important. Now, for example, the NFT, the non-fungible tokens, the digital artwork, which we'll talk also later, it's on the Ethereum platform. So you need to, most of it, not all of it, some of it is in other platforms that are also work with Ethereum. But the point is that you need their token or their coin, which is the ETH, in order to buy that digital artwork. So if I want to buy digital artwork that is on the Ethereum platform, then I need to change, let's say, dollars, or buy ETH or Ether, some people call it, and then with that I can buy the artwork. So again, you have all of these other coins. By the way, this is called a stable coin. So basically, it's a digital dollar. It's pegged to a dollar. It moves with a dollar. Okay. So Solana, for example, and I'm not going to go in detail into most of them, but just to give you a few examples, Solana has grown tremendously, becoming now the third biggest or most important in terms of market capitalization. So market capitalization is basically, the value or the price of the coin times the number of coins. So this is the market capitalization. Another way to think of coins sometimes is almost like if they were shares, okay, because you can basically exchange them, and they are related to the value of the entity or the corporation in this case. And I'm not going to go right now into detail, but you have something called initial coin offerings, which work similar to when you issue shares, but you do it with coins. But anyway, so here this competes with Ethereum. So a lot of these basically are for very specific things, okay, running smart contracts. So Cardano, so another founder of Ethereum, he basically said, you know what, I don't agree with the proof of work to do the verification and so on. It just takes too long. In the case of Bitcoin, on average, a block tends to take 10 minutes. Imagine for a smart contract, which is a lot more complicated to run than just a transaction. So he said, look, what we should do is a proof of staking, and it's a much easier and faster way, and it also has lower transaction fees. So by the way, this proof of stake is now going to be implemented in Ethereum, the 2.0 version. And by the way, staking is also it's a way for participants to basically, you will hear, for example, 2.0, Ethereum 2.0, you can do staking. That means that you're going to get a return for basically, and they tie up your Ether, and then you can use it later on when it's issued. They're going to use that liquidity, okay? You have Polkadot. Oh, and there also is going to be also used for the way of how the consensus is reached. So you participate in that consensus. Again, I don't want to go into a lot of detail because I can spend half an hour talking about this, and that's not the idea. You have Polkadot, again, another one that is a way for blockchains, unrelated blockchains, to talk to each other. So all of these are projects. I just wanted to show you these are all projects. Okay, so this is really what I wanted to get to, which is the blockchain demo. So let's see if, okay. Okay, so this professor, okay, Professor Anders from MIT, I'm not sure if he's still at MIT, but he basically published this demo, and it's online. You can find it here. You can see, and it basically shows in a probably the best possible way that I could find how the blockchain works in each of the different areas. So the first thing that we talked about was the hash. This is the cryptography. So SHA-256, which is what is used for Bitcoin, is basically a secure hash algorithm. So basically, it generates this hash, and this hash. Think of a hash of like a fingerprint. So it's unique to each of the different people. In this case, it would be data. So if I put my name, you can see that it has that hash. But if I keep putting more things and I have all this information, it will generate a hash. So this hash is for this particular content. If I go back, so let me see. So you see DBCO, if I put the number 1, it changes, but if I go, okay, so basically the first part is the hash, generating the hash, which is unique to the contents of what is inside the block. So this is the block, okay? So now the block in the blockchain has other things. It's not only data and a hash. It also has what is called nonce, okay? And what you will notice is that there is going to be a chain of blocks. This is block number 1. And notice that it says 0, 0, 0, 0. So what happens is I put this data, and let's say this was transactions, right? So $22, whatever, it's a transaction. And the hash needs to be related to the other hashes. And remember that before, in order for this block to work, it needs to start with the sequence 0, 0, 0. So I need to mine it, okay? So I need to find a number that starts with that sequence. So if I do it manually, it would take forever. So that's why you have these algorithms and equations that generate these hashes, which is the miners. And the miners are basically a bunch of ASICs machines that are dedicated to do this. See, so this is a demonstration. So you see now it came out with a 0, 0, 0, and it generated this number. So this number with this data generates this fingerprint, if you will. Now, if you look at it in terms of a chain, the chain basically, you have all of these blocks that are being added all the time, and these blocks, each one has a hash, and you can see they all start with 0, 0, 0. Okay, so they have been mined to get to that, and they look back at the previous hash, and we'll see in a moment why that is so important. So again, now we have, before we saw a block, now we have several blocks. Okay, they all have their hash, they all have their nonce, which has been generated depending on the hash. And then the next characteristic that is important is that there is a distributed blockchain. So that means the different peers, A, B, C, and it's open. You can go to the internet, and they need to batch. So now, so in terms of being tamper-proof, okay, if I wanted to make a change, right? You see how all of these now say, oh, somebody tried to tamper. But I could, in theory, I could mine all of these, right, to change the blockchain. The problem is other people have a copy of the blockchain. So you see how I mined this one, and now this hash changed? Well, it doesn't match with this one. So this is why after there is two functions of the miners. First, you do the block once you have generated the correct hash, and then you have to verify the others to see if they all match. Match meaning the hash. This is why the hash is so useful, because you, instead of verifying all the data inside, which could be a lot of information, it just verifies that the hash matches. Okay. Now, so this is how the blockchain works. Now let's look at Bitcoin. In the case of Bitcoin, the data that we have are transactions, right? So Darcy sending to Bingley $25. Now, there is an issue here. How do we know Darcy has enough money to send to Bingley? Okay? So the way it really works, so let's look at now how it works with Coinbase. Coinbase is the main exchange in the United States to buy and sell cryptocurrency. The way it works is okay, Professor Anders, who is the one who created it, the whole demo, basically he bought $100 worth of Bitcoin, right? So deposited $100, and basically now with this $100, he's going to send $10 to Sophia, $20 to Lucas, and so on. Now, after all of this done, wants to check to see, well, we know that he had $100, so he had money to do all of these. But let's say in the case of Emily, Emily now sent $10 to Jackson. How do we know if Emily had enough money? Well, it looks back and he sees that Emily received $15 from Anders, so it verifies that he has enough money to send, and so on. So this is the way it works, and it's being verified, by all the different peers, or in the case of, called nodes. Because what happens is a miner could have thousands of computers, ASICs, and that's why they're called nodes. The nodes are really each of the different computers. So this is basically how it works. The only thing that we're missing here that is not shown is the digital signature. So every time one of these transactions happens, it has a digital signature. Because remember that what it's doing, you don't have names. You basically have public keys. So you have like a bunch of account numbers. So let's look at, so if we go right now to what is called, you go to blockchain.com and explore, which is one of the browsers where you can see the blockchain, you can see how all of this works in real time. So here's the price. You have the current price, hash rate. This is how many hash are being generated. So you have 158 per second transaction. So all this information is really important more for like the miners. Because what happens is you have really two groups of people, if you will, or two groups. You have the ones that are doing the transactions and the ones that are doing all the verifications. Now, why is this is so important? Because they're not only verifying, they're adding the blocks, and they're getting compensated to do both with Bitcoin. Okay, and that's how Bitcoin is created, and it's a very slow process. Just to give you an idea, it is thought that the Bitcoin is going to run out in about 20 years. So it's a very slow process, and every so often they cut the number in half. But the most important thing is I wanted to show you. So you have here. So here, let's say I'm a miner. Okay, I was able to get this hash. I created this block, right? By the way, I'm going to put it in dollars. Why is it called a block? Why is it a block? It's because it can have many transactions. So in this case, okay, this hash was created. This public key sent $458 to this particular one, or bought and sold, okay? And you can see, so this is the public key, which, by the way, I can click this and I can see even more details. So you see this is a QR code, so you can either copy this or scan this, and this is the public key, again, $428. And then with those $428, basically all of these transactions, okay? Sorry, these transactions, these two. And then you have more transactions. Now, what I want you to notice is that it says unconfirmed. It also says if it has been spent or not spent. But so why is this important? Because if we go back, okay, then you can go back and see those blocks that have gone through the whole process. And this one took 9 minutes. So this is a block, and you will see that now everything says confirmed. All of these have been confirmed. See, $504,000. That's a big transaction. By the way, you can put here your transaction ID or your public key, and you can find yours. If you just bought, or even if you bought it a while back, all the information is here. So this is why this is so unique. Can you imagine? I mean, this is open to everybody. It's basically open, and everybody can see it. Everybody can participate. By the way, anybody can be a miner. So this is very unique about this. So let's go back. I see we're in the 34-minute mark, and I didn't want to make this video so long. So the next part, which I think I'm going to do in a separate video, is the other uses of the blockchain. So this will give you, so again, we talked about the basics of how the blockchain works and what it is in the case of Bitcoin, and we saw how each transaction and what a block is and all the information that is there. So what we're going to do in the next video is we're going to talk about the two different types of blockchains. Why is one permission and the other one permissionless, and what are the characteristics? And then we're going to talk about Ethereum and NFT, and then the use cases for the blockchain. So I hope you enjoy this video and that you've learned some of the basics of how the blockchain works and how Bitcoin works. And if you like the video, please click like and subscribe. Thank you.